Data and finance. Wow, man, we can cover a lot of ground on data and finance. In fact, might as well call this data and business because the way we think about it is really quite broad. We can offer one or two comments to frame why I chose the panelists I did and what we're going to do, and then we'll just sit down, have a conversation about the kinds of work they do, and then take questions from all. So that's sort of the planning session. But this whole interest in data and obviously the data science school of data science and all the data analytics that we see and hear so much about, I trace it back to basically one fact, which is in the last decade you've seen an explosion in the availability of data. And what that really comes down to is the data has become more granular, more detailed, more transactional. And that means two things. It means that it is encoded inside, you capture every person's transaction rather than a sale at a store or a university, at a business. You have far more data. The second thing is it's an explosion in the dimensionality of the data. The data has so many more qualities than I. So when I think about the explosion in data analytics and data science, it is largely just a manifestation of the explosion in the dimensionality of the data we have. There's sort of two challenges we have. One challenge is how do I even work with data that is super huge and highly dimensional? The second challenge is how do I make sense of what's going on in there when I have this degree of complexity? And so in putting together this panel on data and finance, for me, the idea was to sort of narrow it just a little bit and sort of address the following question. If we're going to start talking about the data that arises in finance, almost everything is going to be transactions and decisions by people. Aggregated up into market prices, perhaps, aggregated up into sub-market measures such as bid-ask spreads, or totally disaggregated by time, moment, trader, direction, venue. So if there's this human element sitting at the heart of it, then for me the question always is, how do you think about the challenge of modeling or talking about data when the human being sits at the heart of that? And so my two panelists are here who have some thought, engagement, and experience with thinking about humans and their behaviors and how that manifests in data. So again, it's a very small slice, so if you were hoping that I would tell you how to make money using financial data, you would be sorely disappointed. If you were thinking there was a model that we use to model financial data, you'll be disappointed too, because in fact, all analytics is purpose-driven and contextual. And it is meaningless if you don't first think about why, you think about who. And we're just going to focus on one question. We're going to try to have a purpose, try to make some sense of data, and it's going to start with people and what people do and how they think and how they feel. So that's, I'm just framing what we're going to try to do today. So with that focus here, right here I have Pat Dennis, who's a friend and a colleague at the McIntyre School of Commerce, does research in the area of what we call market microstructure. And this is the details of how people trade. So he is the guy who will look at data, and again, he'll talk a little bit in a minute about his research. Greg Frank is a sort of friend of the business here at the university. He is the CEO of Pool and Capital Management. He is a strong and credible practitioner. He is someone, as my colleagues have described, as someone who has walked the walk. So he's done this and knows how to talk the talk, meaning he can talk and converse with people on the academic side as well. And I think that's important for those of us who are researchers and those who are in practice. If you really want to use the insights of academia to help you think, you need how to talk the talk of academia. You have to understand the frameworks they use. If, on the other hand, you want to be a practitioner, you also have to walk the talk. Finding the two, finding the balance between the two is hard. So Greg is someone by reputation who can do both. So with that, what I'm going to do is just ask my friends here to just talk a little bit about one kind of research project perspective or issue they'd like to. And then I've got a couple questions that I'll ask them and sort of help us think about the topic. But most importantly, get questions from you, whatever you're interested in as well. So thus the ground rules, thus the topic, and off we go.
Well, thanks, Mark. So I'd first like to emphasize, as Mark said, we want to make this very interactive. So if you all have questions on anything, you want to ask us, We may not know, we may know, but please, it's a very small group, which is great. So interactivity is lovely. We got the front row filled, which is always nice. So I've got lots of things I can talk about. After hearing Mark's comments, I'm going to reverse the order of what I was going to talk about and talk about a specific project. So as Mark said, I work in the field of microstructure. We've got data on basically every stock trade that has ever happened going back to the 80s. So it's like, hundreds of gigabytes of data. And I've been using this data for various projects, and then one day I was sort of sitting down and actually looking at the data. Just looking at, somebody bought 400 shares of IBM at this price. Somebody bought 500 shares of IBM at this price. And what I started to notice, just looking at the data, as a human, this is no AI neural network. This is me.
Well, it is a neural network.
It is a neural. It's a wet neural network up here. And what I noticed is like trade sizes of 500, 1,500, 2,500 seem to happen really frequently. So you think when you're trading stocks that large trades should happen less frequently than small trades. You should see fewer 400 share trades than you see 300 share trades because it's more money. And you do. When it comes to 500 share trades though, it spikes. So you see many, many more 500 share trades than 400 or 600. You see many, many more 1,500 share trades than 1,400 or 1,600. So I was looking at the data, just like scrolling through and said, wow, this is really interesting. So I just did a histogram. Just took a few stocks and a histogram, and the spikes are enormous. So this is really weird, like what's causing this? So I took it to my finance colleagues and they said, oh, that's all cute, but like, what financial impact does it have? And I didn't have a good answer. So I sat on this for about a year, and then it's bugging me. There's got to be something there. So I called on Tim Wilson in the psychology department and said, Professor Wilson, like, I've got this data. I don't know what's going on. And he said, I don't know what's going on either. Well, why don't you come over to psychology and get a round at it? So sort of this idea of cross-disciplinary research. I had this idea of finance. My finance colleagues couldn't really make sense of it. I felt there was something there. So I gave a brown bag in psychology. So I talked about this idea of like decision making. You want to buy shares of Apple, how many shares should you buy? So at the end of the talk, this kid came up and asked really good questions. He said, wow, I've got really great grad students in psychology. And it turned out he was a professor. So I said, wow, this is great. So I convinced him to work on this project together, and we wrote it up. And it turns out that there are these things in the decimal systems called prominent numbers. So powers of 10, they're halves and they're doubles. So think 2, 5, 10, 20, 50, 100. And it turns out when people make decisions, if you are rushed or under high cognitive load, you tend to anchor on these prominent numbers. So if you have to you want to buy some Apple, how many shares should you buy? Quick. You probably say 500, 1,500, whatever, So we did an experiment. We looked at the Federal Reserve releases their minute meetings 2 p.m. on a Wednesday. It's the only information release that really happens during trading hours. We compared trades when the Federal Reserve released the contents of the meeting minutes to the day before, and there was a statistically significant spike on anchoring on these prominent numbers. So this is experimental, this is financial data evidence that when people are rushed, have to make a decision quickly, they anchor on these prominent numbers. Then we did a series of psychological experiments using human subjects that have got appropriate reviews and all that, and we could replicate it with experiments. And it turns out that this anchoring decisions on prominent numbers, nobody had ever written about it. So we wrote a paper and we got published. So I guess what I want to come back to is that when in data science, to sort of be the devil's advocate, sometimes you just can't throw data into a blender like an AI neural network and get the answer. Sometimes you have to sort of like look at it, think about it, and try to come up with what's really going on here. So anyway, so that's the story of that paper. And I guess I don't want to take all the time here.
No, but I'm going to. I'm going to jump in. It's the prerogative of the organizer of the panel. Just to emphasize the point, how many of you are academics? Consider yourself on the academic side. And then the rest, I guess, practitioner side, so it's somewhat balanced here. What's so great about the research that Todd did was that he designed an experiment to answer not the question, do people anchor? Because actually that's very well known. But do they anchor more when they're rushed? And that is a really important distinction because we tend to think of anchoring as a simplification. And then the real insight of this work is when you're rushed, you simplify more in order to act. And so again, if you want to parse the data, I just want to emphasize it's not just that people anchor. What's fascinating, it's time varying dependent on how rushed you are. Now that goes to my point about how complex large data sets can be and how sophisticated you have to be in understanding what's going on. If you want to make sense of this, and that's exactly what this research did, making sense of the rush aspect of it, not just the anchor.
And in addition to the rush, so we did a couple other experiments. It turns out that when people are lazy, if you're late, you exert low effort, you tend to
find the lazy ones.
We actually did Amazon Mechanical Turk, and we had a proxy for how much effort the Mechanical Turk respondent could put into other questions. So we basically use that as a proxy for how hard they're thinking. And we found that people that think harder anchor less on these 1s, 2s, and 5s. So perhaps it has like applicability toward like, is this data from a lazy person or a hardworking person, or is it fake data, or is it from a human? If it's from a human, it probably has more 1s, 2s, and 5s than if it's just random data. There's actually a paper on finance that looked at prices. Like when you want to buy a stock, you can place what's called a limit order. So I want to buy that stock at 30. So prices that end 1, 2s, and 5s tend to, those purchases tend to do poorer than prices ending not on 1s, 2s, and 5s, kind of consistent with the laziness hypothesis. So I'll stop talking here and give it over to Greg, but I want to kind of emphasize that the importance of looking at data and also the importance of having a model in the background. And I was going to talk about risk and return, but that's another half hour, and I want to turn the floor over to Greg, and so we have time for questions.
Oh, great.
Well, let me pick up on this experiment. So that observation of what happens when people are lazy can also be found when people aren't scared enough. Let me tell you about a data set that I've seen. If you study the daily returns of the hedge funds that blew up in 2007 and in 1998, you'll find an interesting thing, that their Sharpe ratios, their volatilities are lower. So their Sharpe ratios are higher and their volatilities are lower than the competition. And you would think, wait a minute, these people are apparently doing better because their risk versus return metrics are better. Why would they be the ones that blow up? I studied this data and found that there's a positive skew to the set of hedge funds that tended to blow up in financial crises. And then wondered why could this be? And it's because of the phenomenon of gambler's ruin, in which people allocate a proportion of their capital, an increasing proportion of their capital, to a specific bet when they are winning, and when they start losing, they don't decrease it. And as a result, when they start losing or when there's a big crisis, they blow up. And the best example of this was long-term capital management. And a friend of mine studied their daily returns when they were very famous. Long-term capital management is an enormous hedge fund with some very prominent people, including one Nobel Prize winner, Robert Engel, and what happened was that he studied their daily returns and saw this positive skew and said, this very remarkable hedge fund, in which case it was like the IBM of the hedge fund, nobody got fired for allocating to LTCO. This is going to blow up. And he held back from allocating. And lo and behold, it blew up for this specific reason of the positive skews, which evidenced a tendency of overconfidence. Now let me talk about what I was going to talk about, which is another phenomenon that I spot in financial return series that's unusual. So anybody who studies physical phenomena might be used to a certain way of unpacking data. And in finance, there's this thing called volatility clustering. In other words, periods of high volatility tend to be followed immediately by other periods of high volatility in either direction. And periods of low volatility tend to stay there, low volatility. So This phenomenon is called heteroskedasticity. Hetero meaning different, and skedasticity meaning dispersion, so it means different dispersion. Why does that happen? There's a very simple empirical observation that you could make to say, when there's action in financial markets, it makes people pay attention. And when people pay attention, they do things. And as a result, because they do things, there's more action. And the volatility feeds on itself. So if you observe a time series with clustered volatility, and you're a practitioner of traditional data science, you're going to be very surprised by what happens. If you use traditional techniques on a heteroskedastic data set, you'll find that OLS ordinary least squares won't give you the best estimator. Your confidence intervals will be either overstated or understated, and your standard errors will be biased, along with all the other associated tests. And so you need a specifically different approach to deal with heteroskedastic data. Volatility clustering, there was a Nobel Prize awarded to Albert Engel for coming up with a model to describe this method of modeling a time series with heteroskedastic characteristics called ARCH, autoregressive conditional heteroskedasticity. And it was then improved later in the 80s to become a model called GARCH, or generalized ARCH. And GARCH just makes a more parsimonious model in which you can estimate it with a sparser set of parameters. Volatility clustering is something that needs to be treated very carefully, and if you're dealing with a heteroskedastic data set and trying to use traditional approaches, you probably need to find a method of making it homoskedastic in order to attack it with common approaches. I'd like to throw this back to questions because I'm sure there are many of them. So.
Okay, great. I'm going to start with one or two canned questions. They don't know the questions I'm going to ask, so there's a little element of surprise
it's
here.
It's like a test.
Yeah, it is like a test. So Pat, one thing that we talked a little bit though about, and I'd be interested a little more, is partnerships, because part of what this whole data palooza is about, and part of why I'm thinking about the intersection between human behavior and data, is precisely because it's got a multidimensionality. And I mean beyond the multidimensionality of the data, what I'm talking about is the multidimensionality of the disciplines it takes to understand the data. I know, Greg, you've done work with both academia and practice and partnerships. Tell us a little bit about what's that like, what are the advantages, and maybe some pitfalls and worries.
Okay. I started a firm trading foreign exchange in New York when I lived there. And there's a program in the state of New York called SPUR, the Strategic Partnership for Industrial Research. It's sponsored by the state of New York, and it happens with Stony Brook University and several other state universities. The way that it works is that I created a project, a research project. A friend of mine was an academic there and found a PhD student who he said was fantastic. He assigned this PhD student to my project. I paid for this student a stipend and tuition. The state of New York kicked in an additional amount for the university's overheads. The student got a visa, plus since he was from China, managed to be able to work and produce an income. And I got supervised research of the highest quality at a much better price than I could have bought that, at a much lower risk than I could have bought that on the open market. So that's an example of a program that worked really well, and I'd like to see that happen here at UVA, something like a private-public partnership.
And you've also, you were happy with your psychology co-authorship. Whenever you get a paper out of something, that's a win.
Yeah. So it was, I would call that a public-public partnership, because he was at UVA and partnership across grounds. And the more I do research in finance, the more I'm convinced that psychology and behavioral aspects are so important. And even so, we have this concept in economics called risk aversion, that we dislike risk. And that's kind of our standard workforce model, is agents risk averse, but I'd agree that's behavioral. Like, why are we risk averse? Well, that's a behavioral phenomenon. So basically everything that we study is behavioral, and I think that as a finance faculty member, I'm going to keep on leaning more heavily on my psychology co-partners across grounds in the back school and the psychology department, because there's so much that we just don't know yet about how people make decisions. And like this prominent number of papers, one example of that. So the need for cross-disciplinary research, be it finance, mathematics, finance, psychology. Of course, I'm thinking from a finance perspective because that's what I do research on. Is really important to get at interesting new questions. So I'm not sure if that's
Can I pick up on that point a little bit about how you can observe behavioral finance in a data set. So let me tell you about a phenomenon that you will see in daily returns. Firstly, if you take a look at the daily returns, you'll find that it's leptocritoric. So it's got fatter tails than a normal distribution. Another thing so firstly, that should be self-evident, that it's going to be like that you're going to have fat tails. You're not dealing with a physical process, these are human decision making. Then there's another interesting thing. You'll see that the left tail is longer than the right tail. Now, why is that? One hypothesis is that fear is stronger than greed. That when people are scared, they hit the button faster and you'll find a fat long tail. Another hypothesis is leverage effects. And that is, if you find a company that has equity and debt, and let's say the share price falls, now all of a sudden the equity represents a smaller percentage of the enterprise value and therefore is more volatile. And therefore you could hypothesize that decreases in price, in share price, are associated with increases in volatility. Which of those it is, I don't know. But it's an interesting phenomenon to observe.
One of the things about not knowing, my next question is this. The challenge with data is to, as I said, it's purpose and context. It's to generate insight. To me, insight is the combination of having a purposeful view in a certain context, which you get as an insight. So if I'm trying to come up with a trading pattern, or I'm trying to test a new behavioral hypothesis, one of the things is, as these data sets become hyperdimensional, you're going to find false discoveries. I mean, constantly false. I mean, you're just going to find all sorts of beautiful models sitting in this data because I have so much to work with. And so the question for you both is, how do you see us as scientists, as people trying to move forward in a world with intensely hyperdimensional data to try to avoid false discoveries, avoid coming out and saying, I've got the perfect model of the human behavior when it comes to finance. And this is just the fiction of the fact that the data is so large and I ran a sophisticated algorithm.
Can I start?
Yeah, go ahead.
All right, so I wasn't going to talk about this, but I will. So a big multi-dimensional vast data set that's available for free. Anybody can go download it. I'm going to talk about my early paper.
Okay.
Is from the Bureau of Transportation Statistics, is data on airlines. So this data is really interesting because it has every single flight that's ever been taken by anybody in the domestic U.S. Like the time of day, how much you paid, how much you travel with, and the price that you paid. So there's this researcher at the University of Michigan, who shall go nameless, who had this paper that's made a big splash. And his hypothesis, using this big data, was that common ownership affects prices in a negative way. Now, what I mean by that is, like, you have Vanguard and BlackRock that own shares. Let's say Vanguard owns shares in both American Airlines and Delta. And if American Airlines and Delta compete on the same route, let's say Charlottesville to Chicago, then Vanguard or BlackRock will say, hey guys, I own both of you. You compete on the same route. So why don't you compete less and set your prices a bit higher? And other routes, let's say American competes with United, I own American but not United, then I want American to compete really aggressively and set their prices lower. So this fellow in Michigan has this fairly famous paper now called the Anti-Competitive Effects of of common ownership using two huge data sets. The data set of every flight that's ever been taken by anybody in the US, time, route, price, and all this is available for free, and a data set of who owns what. Vanguard, BlackRock, which airlines do they own, when do they own them. So he went through this very complicated analysis and claims that he found a anti-competitive effect of common ownership. This has created quite a stir because the regulators have kind of been saying, well, if this is true, then Vanguard should only own no more than 1% of an airline, or no more than 1% of an
I'm just going to add something here that is important. These owners are passive investors, sort of by definition. So the real shocker here was these are passive mutual funds, not active mutual funds. So this was a big shock.
That's a good point. These are index funds, and all of
They're
you
index
have
funds.
in your 401k, you probably own some Vanguard or own some BlackRock. So if this came to pass, and if regulators forced Vanguard to only own like a teeny amount of American, teeny amount of BlackRock, of Delta, they would basically have to divest in all those economies of scale that we all have in our 401ks, getting very, very cheap index funds, all that would go away. So to answer your question, Mark, about big data and what makes sense, so it didn't really pass the sniff test. That an index fund like Vanguard, who competes on low cost, would actually expend resources to say, like, okay, hey, I'm Vanguard, American and Delta, Charleston to Chicago, why don't you guys keep your prices higher, but then Charlottesville to New York, keep your prices lower. This just didn't pass the sniff test. So a colleague of mine, Carl Scanoni, and myself, and another guy at the Federal Reserve, Chris Girardi, took a look at this data. We spent like 5 years on this project, and basically, it didn't pass the common sense test. When we dug deeper into it, we showed that it's basically an artifact of the way that this common ownership measure is constructed. So I guess, when you've got big data and you get like a kind of a cool result that's like, wow, like there's this anti-competitive effect by index funds, you've got to kind of ask yourself, does it pass the sniff test? We didn't think it did. We've shown that it doesn't. So, yeah, so anyway, so I'm kind of talking about it differently, but
No, that's the perfect example of it.
and this has huge policy implications too, because if Vanguard was forced to become a lot smaller, we'd all have to pay a lot more fees for our retirement account. So it's kind of the intersection of big data, doesn't pass the sniff test, and there's immense public policy implications for this. And it's currently being debated right now, and we'll see what happens in 2020. Anyway, so I don't want to get into that, but I want cheap index funds in my 401k. That's what I want. So.
Right, anything to add on the false discoveries around here? Ever made a false discovery?
Let me first dispute one thing that you said, that we have a lot of data. We actually don't. We have data in certain regimes, and we don't have a lot of data of blowups, of absolute crises. And the best example is the recent financial crisis in which mortgage-backed securities blew up. We had no data to predict that because it was completely out of nowhere. Dating back to every crash that you've ever seen, the error that people make is they think that sample covariance is durable. And they construct a portfolio because they see, oh, okay, I'm just going to take my sample covariance and assume that that's always going to be true and that it's going to be static. And it's not static. What happens in finance is that when things really get bad, they accelerate really quickly and covariances switch to 1. And all of a sudden this very beautifully diversified portfolio that you thought you had crashes very spectacularly. So the challenge I think that we have is not so much making false discoveries, the challenge is limiting risk and actually describing risk or characterizing risk, because this is, in my view, relatively simplistic description of risk as volatility. But if volatility is durable and constantly durable, is that really risk? Is it real? If your price of your assets just go up and down, and you know that they're just going to go up and down, it's just vibration. What you really are afraid about is blowout, tail risk. And how do you describe tail risk without enough empirical data, which you simply don't have? So therefore, we have, I think, a little bit of a different question of how do you constrain the risk of the unknown, of the data that you by definition will never have seen.
Yeah, I would add to it, that's right, that's another sensitivity on the modeling. In economics, they call this the peso problem, for those of you who studied it, and the idea is, if you look at the history of the exchange rate of the peso to the dollar, it would go for like 20 years without ever changing because it was pegged. And if you looked at the forward discount, which is a measure of whether they thought at any given moment it was going to devalue, it was always negative. Like at every moment we thought it's going to devalue, and for 20 years it never did, and then it devalues spectacularly. And the peso problem is a phrase economists use to refer to whenever you look at data, if you don't include the one crash, it looks like the data never made sense. And you just add that one crash and the data makes complete sense. So the problem is when you look at data, so I think it's a great way to think of it, I got to include the crashes when I start looking at data. And this is a related problem whenever data becomes more multidimensional. To tell a tale, I was at a conference and someone had looked at, on a yearly level, whether there was a relationship in the cross-section, and you calculate a measure of statistical validity. And then he said, well, you know, when I looked at a monthly level, it became even more for sure. And so I, being a bit of a jerk, said, yeah, and I bet if you looked at a daily level, it'd be even more for sure. And if you looked at hourly, your t-statistics would blow up. And of course, what this person wasn't doing was controlling for the fact that they were all related, right? They weren't actually independent observations. And so one of the mistakes we make is we add more and more data that isn't truly independent of the data we have. We think we're getting better and better and better, and all we're doing is fooling ourselves to thinking we're becoming more and more accurate, when in fact we've not improved even slightly.
So piling on to what Greg and Mark just talked about a little bit, I want to kind of link it back to like AI and neural networks. So a lot of people think, well, I will just take financial data and feed it into a neural net or AI black box, and then I will get out a trading strategy that makes me really wealthy. Well, there's several problems with it. The first problem is what Greg pointed out, that, you know, crashes, the 2008 crash, the 90, the tech bubble crash, the 87 crash, these things happen once every 10 years. We've got data going back, let's say 100 years, that's an N of 10, right? And the next crash will not look like the previous crashes. So the idea that you have to kind of, you know, it's different than Facebook with facial recognition, where you've got a million faces and you train AI or neural net just to recognize faces. You've got a lot of data and it's multidimensional, and that works fairly well. But finance and economics is different. You know, you take one stock, you know, monthly, even daily stock returns, it's 100, 1,000 observations. So in that context, you need models, almost in like what's called a Bayesian statistical sense, to help guide your decision making. You just can't throw it into a black box alone. You know, if you just throw the data into a black box and say make money, in all likelihood, in sample your black box will make money, but it's forgetting about risk. So we need models of risk. You need models in addition to just a black box, I think, in finance. But the black box works well for Facebook and other big data. It may not work well in finance and economics. Once we have 1 billion years of data and 1 million crashes, you know, then maybe, you know, to Greg's point. So.
Yeah, and I think you anticipated my next question was the most sophisticated models are genetic algorithms, artificial intelligence, like this whole world where we let the data tell us. And the only problem with that is it's a black box. So you don't know what the underlying driver of the model is. At the very least, if I'm trying to model whether people fixate on numbers, at least I know what I'm testing, I know what I'm looking for. I'm looking for this clustering on numbers. I've got a few more questions, but I wanted to just pause for a second, see if there's any questions that you guys have that you would love for our panel to comment on. Yes, Russ?
So you talked a lot about kind of the human factor in markets and decision making. As markets are driven more and more by algorithms, does that attenuate the effect of those findings? Does it just change it, but not in a really critical way? How does that?
So you're talking about the introduction of AI or algorithmic trading, when we get them playing it, and I'm going to piggy on to something that's been recently. I just learned the phrase deep fakes. I don't know how many of you all know deep fakes, right? But I was thinking about like a really sophisticated AI that wants to manipulate you by pretending to be a trader. Could be a deep fake AI. Like it could behave so much like a human, strictly for the point of confusing you and taking advantage of you. And so the sophistication, the problem with AI is both they trade, what does that do to data? But they trade and begin to trade like you for purposes you may not believe in. So what do we do do in this
Why not
world?
take it?
Sure. What I find is that the fundamental primary decisions are still made by humans, but the execution of the trades is increasingly done by algorithms. And so the way that gets evidenced is, let's say that you want to buy a certain number of, well, let's say we're dealing in equities, you want to buy a certain number of shares. The primary decision, the initiation of that trade, is often done by some human oversight. When it gets executed, the trade gets broken up into much smaller pieces, and the way that people trade is much more driven by algorithm. That's an execution strategy to minimize slippage. Slippage is trading costs. It's how much you impact the market by trading, how much you push the market by placing a lot of orders at once, and how much spread you pay, the difference between the buying and the selling price. So there are smart algorithms that break that down, and I think as a result we see fewer and fewer of the round number effect because those trades get broken up into smaller pieces. But taken cumulatively, you're still losing generally with human oversight.
And so an example of, to answer, it's a great question, so I'm going to pile on you too. So back in '87, there was a crash back in '87, and there was this firm called Leland O'Brien and Rubenstein, and what they did, they went to their clients and said, listen, you could buy this fancy thing called portfolio insurance, which it's called a put option. All it is a security that pays you a lot of money when the stock market goes down. So these guys were smart guys because Mark Rubenstein invented one of the option pricing models we use. Said, hey, you don't have to pay all that expensive. You don't pay this much money for this. We can synthetically create it through an algorithm for only this much money. But the algorithm basically said this: if the market goes down, then sell. So run that in a loop, right? And if everybody's running the same loop, what happens is everybody sold, and that was contributed to the instant crash. So to answer your question, I think that algorithms run amok, does present a risk, but also an opportunity. Like I tell my students, we had the flash crash back, what was it, 7 years ago in May?
Yeah.
I forget. So this is going to happen again, and you should just buy stuff. Like just buy it, because the algorithms run amok. So being human, and again having a model, a theory in the back of your mind, and being a wet, soggy brain versus silicon, I think can actually help you make money. When you see this thing, when you see that it's too bad to be really true, that's a buying opportunity. Because I believe it will happen again. The algorithms run amok will create some mess, but that's an opportunity to make some money.
It's a great example.
I'll elaborate on the question, because certainly the first wave of applications of call it artificial intelligence in the bare bones was algorithmic trading for execution costs. But if you think about the strategy of, say, long-term capital management, it's what we would call statistical arbitrage. Basically said, when it wasn't true arbitrage in the sense of, oh, the gold is selling here for, 1,400 an ounce, and over there for 1405. I buy it and sell it, and I make a little money on the trade. What it is I create a synthetic something that looks a lot like a synthetic something else, but not exactly. And if they get too far apart, I expect they will on average converge, which is probably a pretty good bet, and that's pretty much what their trading strategy was. But of course, they ended up in the position where the stuff went further and further afield, for reasons that are complicated, but still. So I do think actually we're seeing more and more algorithms employed in a statistical arbitrage framework where they're trying to look at this complex set of data and make predictions that, well, gold goes up and IBM goes down. Well, look at that, Facebook stock goes up. So I actually do think we're going to see more of, and I know people are already using genetic algorithms to make those kinds of trading. What does that do for our world? Data trading.
Well, just carry on with that example. What does that do? In August 2007, there was something called the quant meltdown, in which specifically just the quant funds had an absolute wipeout, and it wasn't broadly shared. That was pretty curious. And there were some very prominent winners and losers. So firstly, why was it only quant funds that melted down? And broadly, it was because of a concentration of style. This was somewhat studied. There was a concentration of style. Everybody had a predictive model that worked on daily data. And everybody was generally using the same covariance matrix, which means that when converge, And they bought the thing that was cheaper and sold the thing that was more expensive, but it didn't. It just died. And then they said, oh boy, now it's really going to converge. So they bought more of this and sold it. And eventually they said, oh, we're now out of money. Broke. Except there were some smart people, one of whom was Stephen Cohen of SAC. He said, I see what's going on here. Everybody's got the same algo. And they're all following each other. So run all of the algos in reverse. If it says buy, sell, and if it says sell, buy. And he made a mint. Another person who won was Renaissance and Jim Simons, because he could just outlast everybody else. He said this is going to converge eventually after a lot of damages. And it's happened.
That goes to a great phrase is the market can stay irrational longer than you can stay solvent.
Yes.
And that's one of the
That's
problems.
a great phrase. And then there's another fund that blew up, and that was the prediction company, started by a chaos theorist named Doyle Farmer in Santa Fe. And they had been bought by UBS. And their corporate overlords said, we don't really know what's going on here. So on day 2, they completely cut the book of the prediction company and liquidated it. And day 3, everything reverted, and they locked in their loss.
Any other questions? Right here, Mike.
Yeah, just kind of following along with this, is there a way that you could characterize the health of the markets? I mean, in terms of how these algorithms are interacting with humans? Do you have any thoughts on what would be a healthy market versus an unhealthy market? Does that have something to play with these ideas of crashes or micro crashes or?
That's a great opportunity for collaboration. How do you smell a bubble? How do you smell a credit bubble?
And I think it gets to the idea of the health of the market, this idea of systemic risk. That the 2008 housing crisis, you know, all these firms were tied together in ways that people didn't really see. You know, they were trading mortgages and creating these structures out of mortgages, and you know, it was a house of cards ready to come down. And so we didn't fully realize what that. It was very unhealthy. The crash happened, and Dodd-Frank made the market healthier. But I think it's an active area of research. Like how do you quantify like how interconnected things are? If one domino falls over here, does that create a cascade? So in my view, the health of the market is kind of like the internet. Is you've got, if one node goes down, the internet stays up, right? But if you had just like one hub and all spokes, that hub goes down, everything dies. So I think it's an open area of research. How do you quantify how exposed the market is to systemic risk? And so in my view, that's a market.
And both of those answers focus on systemic factors, so the actual collapse of markets. For everybody who's a participant in the market, there's their own measure of what's healthy. If I'm trading instantaneously and I'm trying to make markets, it's that they're fairly stable and I can capture a bid-ask spread. If I'm an informed trader, is the price impact ameliorated over time? Can I trade a whole lot over time? If I, so one of the problems with the notion of health is everybody has a different perspective. So back to the question of everything is about purpose and context. I think one of the struggles we all have when we try to describe anything is we're always describing it through the lens of some purpose or idea. And one person's health. So I love this. When I was visiting economists at the New York Stock Exchange, one of the things that everybody said in one form or another, they said, an up day is a great day. And a down day, not so great. But the worst day is a nothing day. That's because they all make their money in trading. And so for them, a volatile market is the best of all possible markets. Right? Whereas if you're a trader, a volatile market is the worst market. So this is this tricky part of the question.
I mean, hypothesize two markets that are probably unhealthy, but the question is, what are you going to do about it? When is it unhealthy enough for there to be, stage 4? So one is the yield curve right now. Why are interest rates so low? Because there's this plethora of negative yielding debt around the world, and yet equity markets continue to go up. So the fixed income market is telling us something about its expectation of recession. It's saying, we think that yields should be really low because
money is going to be worth less. Then there's the equity market saying, we think there's going to be growth. So you've got this divergence of opinion from enormous, enormous markets. Now, are you going to arbitrage those? It's lived for a long time. So those are unhealthy signs. Negative yielding debt is a crazy phenomenon where you have to pay a central bank money to keep your money safe. That's one unhealthy market. Another one is one kind of unhealthy market. Another one is illiquidity. So a market means buyers and sellers. If there's nobody on the other side of a trade, and you all of a sudden have some reason to have to get out of something, that's a risk. That's a really bad risk. These phenomena of illiquid markets are best illustrated in something that I'm close to, which is the foreign exchange market. The foreign exchange market trades 24 hours a day, or 23.75 hours a day, 5 days a week, because it's not traded by an exchange, it's traded between banks. And between 5 p.m. and 6 p.m. Eastern Time, nobody trades, therefore it's really illiquid. And if a central bank wants to really move a currency, they make some big announcement when there are no counterparties around. The Swiss National Bank was one example where they wanted to depeg the euro from the Swiss franc. And they made an announcement at the most illiquid time. And everybody freaked out and said, whoa, the central bank is intervening. And as a result, the price between euros and Swissy gapped and exceeded anybody's ability to stop it down, because they weren't looking at the number of the amount of trading, they were just looking at the price. And if there's no counterparty to the price, then the price just keeps moving until it finds a counterparty. And when it finds that counterparty and that price movement is some much larger than expected percentage, all of the risk stop losses that people put on get triggered, and that creates an accelerating effect.
Could I pile on to one of your answers? Yeah. Which is great. I want to talk about the yield curve. So you might to go back to your question about market health. So the yield curve, you think about like lending money to a bank CD. The 1-year CD pays less than a 2-year CD. A 3-year CD pays less than a 4-year CD. So you get a bigger rate of return for locking up your money longer. So that's the yield curve slopes up normally. So if you look at when the stock market has crashed in the past like 4 or 5 times, like 87, 99, 2008, the yield curve inverted. So getting kind of negative rates, but the actual conversion where you would earn like 5% for a 1-year loan, but only 3% for a 5-year loan. So if you want to do something tonight, Google, yield curve movie. It's a thing on stockcharts.com. Yield curve movie. You can play a movie of the yield curve on one side of the screen and the stock market on the other side of the screen, and you'll see, going about what Greg was talking about, when the yield curve inverts, so the 10-year rate is lower than the 5-year rate, yield curve sloping down, within the next quarter or 2 quarters, the stock market plummets. It's not a rule, but correlation suggests that the yield curve can
Is it not one of those false positive problems?
It could be a false positive.
Economists have predicted 9 out of the last 5 recessions.
Right.
The yield curve is predicted 18 out of the last 6.
Mark is absolutely right. There's no hard theory about this, but it's fun, it's cute, it's
I think we have time for one more question.
One of the folks at Lehman Brothers in September 2008 going to the Federal Reserve Bank of New York and saying, we're going to go bust on Monday if you don't bail us out. And the Federal Reserve Bank had to decide whether or not to bail them out and what was the implications. And really, they had no idea. What are the innovations in data and analytics that are needed to get better handle on systemic risk? How do you bring data science more into the study of
So in my view, it's who owes what to whom and when. So, I would like to see detailed data on all the derivative contracts between banks and hedge funds, and to have a picture. It's like like the internet, if you will. There's nodes and there's linkages and there's contracts that link firms together. Personally, I would like to see much more detailed data on the actual financial contracts that link firms together to, if you will, build a map of the economy to understand if AIG went bankrupt, what would that do? And like, oh my gosh, that's really bad. Maybe we should fix that, you know, before there's a flood. We don't currently have that level of data, so that's my wish.
I think that's a great idea. We don't because that data is confidential. But if there were a way of doing what the bioinformatics people do, which is anonymizing the data but still tracing it to its ultimate source, there's been a suggestion to use Ethereum for this, to use Ethereum as a method of tracing counterparties. If you could figure out what was the most consequential counterparty that would take down a lot of other things, that would be a great way to...
Yeah, you can fix that before a crisis happens.
Right now, the way that the Fed does it is they do stress tests. So they basically use a VAR test, a value at risk test, and they say, if the value of your book in fixed income were to move 3 sigmas, what would that do to you? But they don't understand why it could move 3 sigmas, 3 sigmas, or what could happen to move it 3 sigmas. That's an unanswerable question.
I'm going to offer maybe a little controversial answer to the question too. I think a lot about the induced traffic problem. I don't know if you all know this. You get traffic on a road, so you make the road better. And that encourages more people to drive on the road, and the traffic just comes back. And so there's a sort of false sense of solution. So here's my problem with that kind of solution versus what I'll call an old school solution. An old school solution to noise and complexity is inventory, right? I keep slack, financial slack if you're a financial institution, inventory if you're a business. I can't predict exactly when someone walks through the door, so I have a fair amount of inventory. What's nice is if suddenly 5 people walk through the door, I can probably handle it. The problem is inventory is expensive, financial slack is expensive. So what do people do? They try to build better and better models so they can better estimate when someone walks through the door. So then they have less and less inventory. So we move it along where we tightened everything, every piece. And my worry is as we build more and more data and more models like that, tighten up the system so much that it looks pretty good, then one little thing you get wrong, the whole thing falls apart. Instead of the old school solution, and this is kind of the value of risk approach for financial institutions, is to make sure you got a good healthy dose of quote inventory, which is in the financial system, it's people who will bear the risk, it's your equity holders. So I do have this little worry about the data-driven solutions to the world because they inevitably drive you to reduce slack. That's almost their purpose. Data in business is to kind of reduce slack and make you more efficient. And I think this just puts you more and more at risk. So that was kind of negative because actually I'm pretty positive about data. Didn't want to end on that note, but let's join me in thanking our panelists.